like, why did we end up with that system? It's for one very simple reason. Paper stock certificates cannot trade very well at scale, right? Like, it used to be people were like running across New York City and like signing things, and then like they would take like weeks to like reconcile everything afterwards. That is why this complicated intermediated system was created. The only way that people knew how to do a pure electronic trading or dematerialized trading of securities was to centralize everything on one giant like government monopolies ledger, right? But with tokens, actually, you can have something exactly like a stock certificate that can trade at scale, right? Without all those problems, right? You just make an NFT, right? And you embed the exact same information that a stock certificate would have, and you just start transferring that around. Voila, you've done it, right? You've scaled it up without the intermediation. So to me, like that is the thesis I think makes sense for tokenizing these things, or one of the biggest theses is you can do it on an unintermediated basis. You kind of have a back to the land movement for securities when people really own this stuff.
Nothing Said on the Edge podcast is a recommendation to buy or sell tokens or securities. This content is for educational and entertainment purposes only. Nothing shared here is financial advice.
Welcome to the Edge podcast. I'm DeFi Dad here with Nomadic. Today's show features the founder of MetaLeX, Gabriel Shapiro, aka LexNode. Gabriel, thanks for joining us. How are you doing?
Thanks for having me. Doing great.
I have learned so much from you over the years. You live at the intersection of your legal expertise. You're clearly an engineer at heart, and you are a builder, you're an investor, you're a longtime Ethereum advocate. We should kick off today with, there was a tweet that Vitalik put out just before we hopped on, just totally threw off like my whole agenda here. He basically tweeted about the state of L2s and the fact that the L1 is going to scale, and that there is a change in terms of that relationship between L1s and L2s. So anyways, I'd rather you explain this, but what can you tell us about what he said here? How are you interpreting Vitalik's thoughts?
Yeah, you're making me want to pull up the tweet, which I will. But I think it literally just happened, and it somewhat pertained to a conversation I had with Optimism's founder in public yesterday. So yeah, it's good to discuss all these things. So basically, I mean, what I take him to be saying is really an admission that the L2 scaling roadmap as a scaling roadmap is a failure for Ethereum. It appears that the main catalyst for him saying that, I mean, many people have argued that for years, was a conversation involving me, Tim Clancy, Mark Tyneway, however you say it, the founder of Optimism, and a couple other people, colluding Node from Zcash, on X, where Mark, the founder of Optimism, which is probably the most famous Ethereum L2, and also is part of a framework of L2. So Base is an Optimism L2. A number of others are. Somewhat shockingly, basically said that he never plans to doesn't want to get to stage 2 for Optimism, and that it doesn't matter, and that he wants to sell his technology to customers who like to control their chain for legal and regulatory and commercial reasons. This was shocking to some people. It made some people angry. And apparently it prompted this post today from Vitalik, basically saying, he directly alluded to that tweet, and as part of a longer sequence of thoughts about how, L2s aren't really scaling Ethereum. They are no longer what he calls branded shards of Ethereum, where they never became that. They were supposed to be that. And so it's time really to focus back on scaling the L1 with this new ZK EVM strategy. And he also alluded to a new sort of roll-up strategy that, frankly, I don't know a lot about technically. This was my first time reading about it, but he referred to these precompiles, L2s with precompiles, and how that should be the new strategy that basically they will fork with Ethereum, Ethereum will fork with them, they will stay in sync, and all these other things that exist like Optimism, like Base, like this new, I suppose, Robinhood L2 that's coming out in affiliation with Arbitrum, like Arbitrum itself. They will be sort of like things that are connected to Ethereum and maybe Ethereum sympathetic, but they are not scaling Ethereum as such, and thus, I guess, they're not really part of Ethereum anymore.
Maybe there's some more context here that we should have you hopefully be able to explain for the audience. There's always been a push for this neutral, uncensorable L1. I think that for those of us who came into the space where, it was really just Bitcoin, and then eventually you have Ethereum, there was the promise of, can we build applications that are uncensorable with these smart contracts? Eventually we get to layer twos, because at some point when the ultimate product market fit for DeFi takes off, the L1 becomes so congested that it was costing us hundreds of dollars to do simple transactions. So L1 became unusable. It was like the most popular club, in the city, and nobody can get in. And that was at odds with, I think, Vitalik's vision and a lot of our hopes to create this like world ledger that anyone can access. And so L2s were fast and cheap to be able to start to use, but there's some give and take there to that. So in DeFi, yield shouldn't come from chasing dashboards or timing markets. KPK runs non-custodial vaults and on-chain funds built for stable, risk-adjusted returns. Capital is allocated across curated strategies and managed by automated agents that act within seconds under predefined controls. No custody, no manual intervention, just disciplined execution on-chain. If you're allocating capital and want sustainable yield with stronger controls, visit kpk.io. Ever since the basis trade, DeFi has searched for yield that actually scales. Until now. Main Street brings the options box spread to DeFi, a proven delta-neutral strategy. Paired with Accountable's real-time proof of reserves, MSY captures a multi-billion-dollar source of TradFi yield and redirects it on-chain. Institutional yield now built for everyone. To learn more, go to mainstreet.finance. Accountable is the new standard for real-time financial verification. In crypto, financial health still runs on screenshots, lagging audits, and blind trust. But Accountable changes that. Powered by the Data Verification Network, it proves assets and liabilities privately across wallets, exchanges, custodians, and banks. Accountable already secures over $2 billion in verified assets across 115 chains and over 90 data sources. To learn more, go to accountable.capital. In DeFi, most stablecoins ask you to trust them. Trust the collateral, trust the peg, trust the managed risk, but Noon proves it. The stablecoin built for the highest yields, highest returns, long-term. With transparent reserves, real assets, and delta-neutral strategies, access real yields in real time. To learn more, visit app.noon.capital/vaults. Neutral is the next generation of crypto-native yield. Their synthetic dollar NUSD taps into OTC arbitrage, funding rate inefficiencies, and delta-neutral strategies to deliver premium, stable returns without taking market direction risk. Neutral is now officially live to mint NUSD and start earning neutral points. Learn more at neutral.fi.
Yeah, the philosophy was really like, well, we want a maximally decentralized and autonomous system, right? We want many, many validators. We want the validator set to be permissionless. We want, anyone, we want a mempool, which many newer smart contract chains don't have, right? Because that's, means anyone can put a transaction in and anyone can draw from that pool transparently, right? These sorts of things. And we want anyone to be able to run a node, a validator in their house, basically. And we want geographical diversity. So even if they have, poor internet, poor bandwidth, whatever, they could still participate in Ethereum's consensus. And obviously one way of scaling the chain would be to compromise on the decentralization, right? You impose much higher hardware requirements, much higher internet bandwidth requirements, And what that will make the chain go faster, right? That plus some other things. I mean, obviously there are architectural things you can also do. Like, for example, Solana is the epitome of the philosophy I'm talking about. Really, really beefy validators. I mean, so I forget the estimates, but the estimates for how much stake you have to have and the type of equipment that you have to run a profitable Solana validator. I mean, it's astronomical, and it's completely outside the reach of a hobbyist, on their own. And almost all the validators are in commercial data centers, so that people don't run them out of their house, right? So you can do that, and things will go faster, and like you can make some architectural tweaks, like not having a mempool anymore, right? And some of these other things. And Solana does those really, really well. And Ethereum didn't want to do those because it wanted to stay maximally decentralized. So the idea is, okay, we'll have these more centralized chains that just use the base layer for proving, and for exiting to, in case the operator of that centralized chain does some type of abuse. There'll be this guaranteed exit path, right? And this guaranteed ability to prove that the operator did something bad by referring back to the incorruptible data on Ethereum. But that chain can be much more centralized, much faster, much more specialized, perhaps, with like some kind of base layer order book or whatever it might be, right? And so that was the philosophy, and it's a very logical philosophy. And it also happened to have some, I would say they were commercial benefits. Some people argued they were negatives, where suddenly, an institution or a big company like Robinhood or like Coinbase that maybe was saying to themselves, hey, I think I might want to have a Coinbase chain, or I might want to have a Robinhood chain. Instead of just making a completely independent chain, they would maybe now do this thing where they connect up that chain to Ethereum in a way that, even though it's more centralized, whatever, it gives, it still borrows security guarantees from Ethereum by giving their users this guaranteed exit path back, right? And so that also kind of enabled us to form these kind of commercial alliances with these enterprises that otherwise might just try to make the next Solana or whatever, that's just a pure competitor. So it was interesting in that way, but it seems like none of these, increasingly the L2 teams were becoming clearer and clearer on the fact that they don't really intend to make the exit guarantees as robust as was initially planned. And so, that's kind of the problem that we face, as well as some economic problems, like all of them launch their own tokens rather than solely using ETH, right? And that in some sense competes economically with ETH, and this sort of thing.
This comes on the heels of Vitalik maybe stating a month ago, I think he's about a month ago, where he said, we've solved the trilemma. So something that I've seen, and just, I'll explain the trilemma again. It's basically this triangle of like, you can't really have all three of decentralization, security, and scalability. And Vitalik's signaling that we have that ability now, which is huge. So I've always kind of felt that the leverage for a while ago, was in the hands of the L2s for some reason, and that felt incongruent. It felt like that was off. But I've felt recently, as the EF has kind of realigned, I think there's all these other startup teams that seem to be hitting the ground running, and we're seeing the L1 scale. Like, it's cheap to use right now if you've been using it. I've felt that leverage shift. And I think Vitalik's, not to get into his head, but I think his primary concern was decentralization. But I just think he also sees the path now of speed and of having all the elements of that triangle. And that's super powerful, and it's exciting. And I think we've all been surprised with how quickly, ZK has progressed as well. I think we were talking on another podcast. It seems like the ZK roadmap was pulled up like 2 years, and we're all like, oh, this shit works right now. Wow. And you can see just in that tweet, again, we'll flash this up a bunch of times throughout this little conversation here. But, he even says pretty confidently, even in 2026, the L1 is going to scale dramatically. So I'm really curious how the bases of the world, how the arbitrums of the world, how they feel in this moment, how they react. I mean, hey, look, they still have the benefit of Ethereum security. They're not paying a ton of money to be secure. But yeah, curious what your take is on that, Gabriel.
I mean, they do, and they don't have the benefit, right? I mean, ultimately, most of these things still have a security council that is capable of doing instant upgrades to their smart contract on Ethereum, which really kind of undermines. Now, they're legaled up. I can comment on this because I've worked on some of these security councils as a lawyer, right? And in fact, I sit on a couple of security councils. But that is the stark reality, and they didn't really want to move beyond that because they say to themselves, if there's a hack or something, I just want to be able to stop it, and if that means my users have to trust me to don't be evil instead of can't be evil, I'm willing to live with that. So what will they do? I don't know. Personally, I think Mark, the founder of Optimisms, I don't know how to pronounce his last name, Mark Tianwei. He kind of, I think, hinted at why are these things even L2s at all, right? Like why does Coinbase want to have an L2 as opposed to just going to having its own full blockchain, right? And I do think a part of it was that there was a convenient narrative of, hey, this is not decentralized right now, but there's this roadmap with these stages. It's recognized by Vitalik. It's recognized by L2 Beat. We're going to get there eventually. And we're really part of Ethereum, right? So we are decentralized. It looks like we're very centralized, but we're part of Ethereum, so we're decentralized. And that kind of, it was a legal loophole for them, I feel like. And Mark basically admitted that, where they could get all the same favorable regulatory treatment as if they're decentralized while having none of the downsides and costs of decentralization, right? Years ago when I first started learning about stage 0 L2s, right? My initial reaction was a lawyer is like, this is a money services business, right? This is an unlicensed money services. They have custody over users' funds. Then I got more sophisticated and realized what the roadmap is. I started saying, okay, you know what? Actually, if they do get to stage 2, it's non-custodial at that point. And, I don't think that needs to be regulated, but none of them are getting there. And so how will they respond? I think will no longer be a benefit to them of calling themselves a roll up and this sort of thing. And so a lot of them will I think just graduate to being full-fledged blockchains, with a bridge to Ethereum, maybe a native bridge, rather than a sloppy one. But Base already has native bridges both to Ethereum and Solana, for example. So, it's already getting pretty close to that. So I think that's what will happen. That will have some detriments to Ethereum because now it's no longer going to be like, oh, Robinhood announced an L2. This is a really big win for Ethereum, right? No, now it's going to be Robinhood announced a chain that's an EVM chain with a bridge to Ethereum. Doesn't quite have the same rate to it, right? So that's my guess as to what will happen. But I think that probably was going to happen anyway because Base announced they're probably going to do their own token and so on and so forth.
Would you ever see the possibility of them being more urgent than to become a stage 2 L2? Remind us, what does it mean if you become a stage 2 L2? What's been holding back some of these more prominent L2s from progressing to that? I know that there's drawbacks. I'm not the best to articulate it.
My sense, I'm not super deep on the technicals, but I know from the security councils I've sat on, these proving systems have bugs, right? And that makes people, if you graduate to stage 2, it means you can't just instantly fix a bug without any notice to people, right? They have to have a guaranteed exit window, before there's a major change in this sort of thing. And so that means that, the chain and other people may suffer the adverse consequences of a bug, and people get very nervous about that, both from a legal and from a commercial point of view, right? It's just like with immutable DeFi smart contracts on Ethereum, right? When these hacks happen on Ethereum, yes, it was decentralized, it was autonomous, but the downside of that is that no one can reverse anything or stop anything if something bad is happening, and those events can be absolutely devastating. And it seems like with these larger commercial entities running L2s, they're just not willing to deal with that type of downside. And I guess they'd rather take the legal risk that FinCEN or someone comes and says you have to get a license or something to keep running this chain than to take the commercial type of risk of, oh, North Korea stole everyone's money, right? Yeah.
So all of this will sort of come back to MetaLeX, but I want to take another quick detour before we get there. I've seen you tweeting a lot about RWAs, tokenized securities, and that's something we know you're working on at MetaLeX as well, solutions. But maybe you could give us some of the problems that you see with what's happening out there on the RWA frontier right now. And yeah, I think we'll get into ways that we can maybe do it better, or that you're proposing to do it better.
Yeah. I mean, everybody knows that they want RWA tokenization, but most people in crypto don't have a traditional corporate finance background, which I do. I was basically a Wall Street M&A lawyer for 8 years before getting into crypto, right? So they don't have that sophistication in the first place to understand what is a securitization, what even is a security, how do these things normally work, what does it mean that you have a share of stock? Most people in crypto just don't even know corporate finance 101. So that contributes to the issue. And then there is all of these, questions of different ways to tokenize and different philosophies of why that you would tokenize an RWA, right? What are you trying to achieve? And I'd say, the first thing I wrote in crypto, because the reason I got into crypto was, as an M&A lawyer, we had a deal escrow on every deal, right? It was like a holdback of some of the purchase price to indemnify the purchaser if something is wrong with the company, right? Last 18 months, you park it in Wells Fargo, there's an escrow agreement, this stuff. And when I read about Ethereum smart contracts, I said, oh, that's an escrow without an escrow agent. This could be huge. This could be very disruptive. You no longer need the bank as part of that equation. Ethereum serves that function trustlessly, right? I just got that very quickly, right? And so, that got me into RWAs and all these things. So the first thing I wrote was this paper, Tokenizing Corporate Capital Stock. And I argued that there's a specific set of reasons and a specific set of methods for why you would want to do this, right? And the main reason really is that traditional public equity markets are highly, highly intermediated. No one owns their stock. This came up in the Wall Street Bets movement, with all the GameStop stuff. There are no property rights in stock anymore. No one really owns their stock. Almost all stock, frankly, almost all publicly trading securities, period, are owned by an entity called Cede Company. And Cede Company is a trust company. It's like the literal record shareholder of every public company. It has what's called jumbo certificates. And so it'll say, let's just say Apple has 1 billion shares. I don't know if that's right. It will say Cede Co owns 1 billion Apple shares. So Cede Co is the actual owner of all of Apple shares. Cede Co then has deals with other entities where it flows down what are called securities entitlements. And it's literally like a waterfall, going from broker to broker to broker to broker. Then there's this other entity called Broadridge. Broadridge is the one who knows who owns those securities entitlements. And it's actually a really, to us, what seems like a retarded privacy system, because the privacy is just from the fact that Broadridge knows who the holders are. And if you as a holder select to be what's called an OBO, an objecting beneficial owner, then they agree not to disclose your name to the world, right? That's their version of zero knowledge. So then there's that entity, and that kind of manages that aspect of who the beneficial holders of these entitlements are. So it's heavily intermediated, and not only is this inefficient in the sense of you have all these different systems, you have to reconcile them, all these different brokers and things are extracting rent all along the way, but also it actually really does cause problems. There's a famous article by a Delaware Chancery judge where he talks about the Dell take private transaction and how there were a bunch of stockholders who hated that transaction and wanted to dissent from it. But because they couldn't prove their ownership as of the right date because of this incredibly complicated system, they were registered as voting yes, even though they tried everything possible to vote no, right? So this actually causes real problems in addition to the rent extraction and everything else, right?
MNT is now live on Solana, powered by Mantle Super Portal, where real-world finance and internet capital markets flow. Access Solana native DeFi with MNT by trading, swapping, providing liquidity, and more to maximize your yield. You can now teleport MNT between Solana and Ethereum instantly, securely, and seamlessly at superportal.mantle.xyz. Puffer is building the ultimate vertical in crypto. Your crypto deserves better yields. Better yields require better infrastructure, and Puffer is building it. Puffer Liquid Staking delivers above-market ETH yields, secured with up to $5 billion in slashing penalty protection and buffer. Puffer Institutional offers compliant, secure, above-market ETH yields for DATs, institutions, and large players. Puffer Unify is the first synchronously composable rollup, enabling the next generation of app chains on Ethereum with sub-10 millisecond transactions. Unify AVS enables pre-confirmations, making Ethereum validators more profitable and rollups more scalable. Puffer is premier infrastructure and yield for digital assets. Stake your ETH at app.puffer.fi.
Like, why did we end up with that system? It's for one very simple reason. Paper stock certificates cannot trade very well at scale, right? Like, you're running, it used to be people were like running across New York City and like signing things, and then like they would take like weeks to like reconcile everything afterwards. That is why this complicated intermediated system was created. The only way that people knew how to do a pure electronic trading or dematerialized trading of securities was to centralize everything on one giant like government monopolies ledger, right? And it only have one owner of the securities, right? But with tokens, actually, you can have something exactly like a stock certificate that can trade at scale, right? Without all those problems, right? You just make an NFT, right? And you embed the exact same information that a stock certificate would have, and you just start transferring that around. Voila, you've done it, right? You've scaled it up without the intermediation. So to me, like that is the thesis I think makes sense for tokenizing these things, or one of the biggest theses is that you can do it on an unintermediated basis. You kind of have a back to the land movement for securities when people really own this stuff. There's a different viewpoint of just people just like to bet on stuff. Let's just get them exposure to it any way we can, right? And so that would argue for importing the existing system as much as possible rather than disrupting it. So that would mean that you don't try to tokenize the stock. Cede owns that stock. They don't want to tokenize it. You start tokenizing these securities entitlements, right? Or you could go even more indirect. You could have a legal entity that owns the securities entitlements, and then the legal entity tokenizes claims on that legal entity, right? Or you can have like even weirder things where like you tokenize an instruction to a broker to instruct a transfer agent to instruct DTCC to change its ledger, and so you're now trading this in tokenized instruction, right? So those are the three main philosophies, and then there's just SITs, right? Just perps, things like that, just pure synthetic exposure. Those are the different ways people are doing it, and not a lot of people understand all the different models and how you might get rugged in the different models and like why you might do these different models.
Canton has been front and center with the idea of like stocks trading eventually on chain, and they're clearly making some compromises on the way that they've designed their blockchain. I guess, can you just dumb down for us, like, where do they fit into all of this?
Their mentality is, let's have a proof of authority chain among the existing players in the existing capital market structure and get them to tokenize what they already have, right? So DTCC, which is the affiliate of Cede Co that owns all the shares, right? They are one of the permitted, nodes or validators. They're called super validators actually on Canton. Broadridge is another one. Broadridge actually is the biggest single owner of Canton. And so it's this more kind of consortium approach where you take existing Wall Street players, you make them super validators on this kind of system, and with their cooperation, you would tokenize, for example, DTCC's, the entitlements that DTCC issues that ultimately trace back to real securities owned by Cede, right? And you would go and you would trade those things, right? And it's a very different system. I mean, it has a really long history. It wasn't always called Canton. I think it was called like Digital Asset Markets, and it basically was founded by an executive at J.P. Morgan many years ago. They have their own smart contract language called DAML, and a lot of it is somewhat strange things that made sense back then in terms of design. Like Ethereum was very new back then, right, and didn't have all the things that it has now. I think back then they looked at some flaws in Ethereum and said, oh, well, you could never trade securities on this thing. And so they designed a bunch of stuff, tried to design a better system for trading securities. And back then it was. But now, of course, things have evolved dramatically, right? Like we have ZK Sync Providiums, for example, that can connect up with Ethereum and even you can leave all the assets on Ethereum and you can just do the computation privately, right? And that can cause a movement of assets back on Ethereum. And so I feel like if all those things had existed back then, they never would have built this. But at the time, it arguably made some sense, right? So they're not even actually a blockchain. So they're right. It's a DAG, right? A blockchain is a type of DAG, but this is a different type of DAG. And essentially, there's no state. Like you could never have like a fork, right? Unless you could never have a contentious fork, put it that way. You can never issue a crypto native asset on it because a crypto native asset, like the only security guarantees people have about what is the supply of that asset or what are the properties of it, the fact that it'll remain transferable and so on, or come from a blockchain, right? But you could never, the blockchain state is not accessible to any general person on Canton, so they could never rely on the blockchain state as the authority for asset issuance. It's purpose built to only support referential assets that you trust someone about, right?
Yeah, and then another setup that I've kind of learned about, I think this last week actually, is there's another major dependency for a lot of these tokenized equities on, chains like Hyperliquid. I think Felix is doing this via Ondo, but they're using this US regulated broker-dealer called Alpaca. And this system works something like, user buys the token on chain. The issuer Alpaca is this intermediary. They execute the stock trade. They hold it in custody. And then this on-chain token kind of mirrors what Alpaca, this other intermediary, is doing. So Alpaca, essentially, they do execution, custody, they do compliance, I guess. And I just think we're going to have probably a ton of this flowing through this one sort of intermediary, and I don't even know if that's good or bad either. It's
extremely risky.
Yeah,
I mean, people worry. There was that article from Dragonfly right at the start of sort of like shortly before DeFi summer back in 2020, where they said Ethereum is now effectively unforkable thanks to DeFi. But notwithstanding the title, what it was about was custodial stablecoins, right? And the fact that if there ever were a contentious hard fork of Ethereum, Circle and Tether would probably have outsized political influence over that, because whichever chain they don't pick, whichever fork they don't pick, the DeFi on that chain is going to be wrecked, which creates a strong sort of like need, or like you could say incentive, I guess, but it's almost like a need for the DeFi protocols to agree with what Circle agrees with, right? And so those are only like, I don't know how many billions of dollars, but compared to the 83% of securities that DTCC owns, right? Or it's like 80, that's trillions. And so imagine a scenario where all of the tokenized securities are basically like stable coins from DTCC, right? They're securities entitlements from DTCC, and how that could affect contentious hard fork choice, right? And so this is very, it's the same thing with that other broker dealer you mentioned, albeit they don't have anywhere near, DTCC's size, but it's it gets very scary to have this model if this model of tokenization becomes dominant.
Okay, so I think it was last week that Lighter or Hyperliquid, it saw their silver trading volume for perps. It was like the highest it had ever been. I think the only market that had more volume was their Bitcoin perps. So we see the demand on chain to trade real world assets, but it's all within perps. We see that Robinhood wants to enable this 24/7 trading on the Robinhood chain or Ethereum L2. After this conversation, I'm not quite sure what it is. So they want to enable tokenized stocks. And correct me if I'm misunderstanding this, but like, again, perps, you're trading something that is synthetic versus if you were to own a tokenized stock, I believe in the kind of world that you're working towards, and this is probably a great segue to get into MetaLeX, the world that you're working towards is where you have real, like, self-custodial type ownership of a stock. And hence, if you own a stock on chain or any real world asset on chain, the way that we own digitally native assets like ETH, well, now you can do really powerful things like knowing that you have the property rights to that. You could maybe put it up as collateral and borrow against it on something like Aave. So yeah, can you just talk to us more about what does it take for us to properly issue RWAs on chain so that we have real ownership of it? And it sounds like MetaLeX is part of the solution to this, or it is the solution to this.
I might jump in quick, Gabriel. I would actually just love for us to kind of level set on, hey, what is your vision for MetaLeX first? Like, what is MetaLeX? And then maybe take the tokenization side.
Yeah. So MetaLeX is a company I founded 2.5 years ago with support from Delphi Labs and Cyberfund. And it originally was focused on putting DAO-related entities on chain, right? Because this was the height of the Gensler era when I first started thinking about this. I had a lot of clients with security multi-sigs and this sort of thing, and wanting to know, what's a way that we can have some of these things legally protected, right? And so I came up with a system for basically, okay, we're going to wrap like multi-sigs and things like that into certain types of legal entities. These are going to be very special types of entities. They're going to cross-reference smart contracts, right? And the smart contracts are going to be connected back to DAO smart contracts. And this is going to create a mix of legal protections and legal contract mechanisms and smart contract mechanisms, so that even though a DAO may not be a legal person, if it's able to act on chain, it can sort of like access the legal layer directly, right? And so that was our initial mission. What I found is that I started to realize that putting entities on chain, whether it's a DAO-related entity or anything else, is really like a single set of problems and solutions. And the difference between a corporation with stockholders and a DAO-adjacent entity with a DAO and token holders is actually not like it's all on a continuum, right? And so I sort of think, okay, this should actually just be like a generalized entity protocol, and I'll revive my very old interest of tokenized securities at the same time, right? Because there's no, like right now, all these tokenized securities protocols are, if you could even call them protocols, I would say some are just not even protocols, but they really just focus on the asset, right? But to me, the asset is meaningless in and of itself. It needs to be connected up with a corporate governance logic that determines, that is the issuance authority of that asset, that is the programmability authority of that asset, and that actually that asset can also feed back into, much like a DAO, right? Like if a DAO is changing the parameters of its own protocol, right? That would be possible. And so we pivoted more to focusing on real world entities and specifically venture-backed startups. And the first app that we did was on-chain venture fundraising. To come do your safe round or your safe and token warrant round or your SAFT round or whatever, completely on-chain as a DApp, right? And so that means the money goes into escrow. That means the company has a digital duplicate on chain. We call them cybercorps that is going to take that money in, navigate that deal, make sure that it follows the terms. And the investor at the end will get an NFT that represents the security that they just bought, right? And so this becomes like an on-chain corporate finance system. So that's what we're doing. And it's securities tokenization, but it's a very different type of model. We could talk more about how it's different and why it's different and so on. But at a high level, that's what we're doing.
Do you remember open law back in the day? When I first...
Yes, I do. I do. Yeah. Aaron Wright. Yes. Consensus.
You must have taken some inspiration. I mean, these were early days, and what you're building, I recognize is much more advanced. But it made me smile because open law was one of the first Web3 related projects outside of money on Ethereum that I was just enamored with. I thought it was so cool. It's part of the reason I eventually worked at Consensus. I just was like, this is the future. I want to work on this.
It's a very cool project. Yeah, Aaron Wright and Primavera de Filippi, I believe her name is. They were really ahead of the game and influenced a lot of us lawyers getting into this. And there's actually a whole thread you could follow. Open law. There was a project before open law called Eris, which was Preston Burns' project. And their big mistake was that Preston Bird, God bless him, he was convinced ETH was a security, and so they rejected all the Ethereum integration, right? And I think were some kind of Cosmos thing, and then that kind of a lot of their ideas were started to be explored with open law again, and then both open law, like Aaron Wright and me separately did the first legal venture DAOs on chain at about the same time. And I kind of consider those the first BORGs, right? The first true hybrid legal smart contract entities. And then it leads on to MetaLeX. Yeah.
Wait, can you just explain what a BORG is? That was actually on my list. I saw it in the...
Yeah. A BORG was what we initially called the entities that we create, right? And the key distinguishing feature from them, part of the reason I coined the term was that people were calling more and more things DAOs. Like basically any type of entity or organization that uses smart contracts at any point, people were calling DAOs. And if you go back and read the original DAO literature, that is not the meaning of DAO, right? It's a much more, it's really meant to be decentralized and autonomous, right? So I wanted to distinguish these entities that use smart contracts as a core part of their functioning and governance from DAOs, right? And so I came up with just the idea, it's a cybernetic org. It's a BORG, right? And BORG is also a term used in the game Cyberpunk 2077 for technologically augmented people, right? In fact, there's even a famous phrase from that show that some particular character is all Borg, no organic, which means he has no organic parts left. And so, that's kind of the name for when an entity will say in its articles of incorporation, certificate of incorporation, whatever, hey, to make such and such decision, go vote or do something with such and such smart contract at such and such address. Obviously, you got to provide an upgrade path and things like that in case the address might change. But that's the core idea, and I believe it's actually a very powerful idea. Yeah.
It's very cool. I want to get into some of these implications that I've been thinking in my head. I don't know if this is the roadmap for you, but I think what you can do with a fully on-chain corp, especially with the rise of what we're seeing with agents, gets really wild. But first, before we kind of get to that stuff, you put an announcement recently, or MetaLeX did, about your V2. It looks like a lot of the things we've kind of already talked about have all had an upgrade. So you've got CyberRays V2, you've got LexChecks V2, and then this MetaLeX tokenized security protocol. Maybe anything in there that we should key in on that we haven't already talked about?
Yeah, well, it's basically, I don't think there's anything like it in crypto or in finance, to be honest.
Katana is an opinionated blockchain. Its opinion is that for DeFi adoption, there are two key things we need: deep liquidity and high yield.
To learn more, go to katana.network. Hey folks, I want to tell you about our sponsor Gearbox, the protocol that reimagines on-chain lending. With Gearbox, you can access 10x credit across DeFi or lend for passive yields with single asset deposits and no impermanent loss. Users can access leverage to margin trade, stake, farm, and more. To learn more about Gearbox, go to gearbox.fi.
While we were building it, Stripe came out with just like a very primitive version of doing a safe round in their app. And I looked at it, I just said, oh man, we're really on the right track here, because this is just like a way inferior version of what we're doing. So basically, the smart contracts are implementing the full legal logic of a venture round, right? And that means that the brilliance of it, I think, the design space is really opened up by using private key infrastructure from your crypto wallet. Because the key insight that I had, maybe, I don't know, like a year and a half ago, is you can use your private key simultaneously as a legal authority and as a bearer asset spending authority. And what this means is that for the first time in history, you can create unbreachable legal agreements, right? Because you can atomically sign and perform the very agreement you're signing in a single step, and there's no way that you can rug someone, right? So there are all these and specific that can work in many contexts, but just to take the context of the cyber raise, a venture round, you might recall there was a lawsuit between Rick Burton and Uniswap, where Rick Burton had signed a simple agreement for future equity, but like he forgot to send the money or something. And there was another similar dispute between the Curve founders and I believe a venture fund called Parify, maybe some other venture funds, where they sent the money, but they never signed the contract. And both of these resulted in lawsuits, right? And so these types of lawsuits are made impossible by our application. Because like you don't go to DocuSign and then, I got to remember to send the money in a few days or whatever. It all happens atomically and basically trustlessly. So I think this is like a very powerful set of primitives, and we are going to be applying this same design philosophy to everything that we do. You can imagine so many extra things you could build out. Like once you've tokenized the safes, okay, now the safes can programmatically convert into the stock when it comes time. Now the stock is tokenized. Okay, it's preferred stock. So that means it has liquidation preference. Well, you could program the liquidation preference into the stock on chain so that when there's a liquidation event, okay, the company maybe it just has in its certificate of incorporation. If you get acquired or if you have a merger, you're going to send all the money to this smart contract, right? And then that smart contract will have the right rules for distributing it according to the liquidation preferences. So there's just many things that you can do with this. And yeah, it's really trying to put as much of the logic on chain, trustlessly and unruggably as possible. And this is very different from just saying, we're just going to throw out a token and just say it represents this certain share of stock, right?
So if you're an angel or you're a VC, whoever, if you're investing today, there's like this common stack that you refer to in a tweet, which you call out that MetaLeX is like Carta plus AngelList plus DocuSign plus Cooley all in one. You also referenced atomically, that this all happens atomically. Can you just dumb that all down for the audience? I want to make sure we understand what this means.
There are all these corporate finance sort of SaaS tools out there, right? How do private companies currently track their stock? Well, they don't have that complicated intermediated system I previously mentioned, because the stock mostly doesn't move, right? So they just have, a ledger, right? That ledger for most companies lives on the servers of a company called Carta, right? You log in, they could tamper with it at any time. They could go out of business at any time. Your records could be erased, right? In my opinion, that's just not a very great setup. It's also, subscription based. You got to have calls with sales guys, all this stuff. Doing this stuff on chain with smart contracts. I mean, MetaLeX provides a convenient sort of interface to it. But, if we went out of business tomorrow, your ledger is Ethereum. It's not on our server, right? So just that sort of thing is a big kind of trust reduction. And then in terms of the deal execution, right now, I'd say the entire legal and corporate finance industry is skeuomorphic in a sense, where it's still like it used to be done on pieces of paper. People pass them around and put pen marks on them and stuff like that. And when we came time to digitize, we just said, well, we'll just throw these same pieces of paper as PDFs, right? And so when you go to sign a document, we'll upload it to this app called DocuSign, and we'll like have a little squiggly line, and you'll like drag it into certain places on this like picture of a page, right? And like, if you really sit back and think about it, none of this makes any sense. There's no reason for the squiggly line. It's not doing anything, right? So like you could just like cryptographically like sign an agreement, right? And you don't have to like put these squiggly lines in places. So that's really what it is. It's just much more efficient. The atomic part is that your signing is your private key signing a transaction payload on Ethereum, right? A hash of an IPFS agreement, perhaps certain specific variables of that agreement, like specifically called out and separately represented, like the valuation cap of the security, if you want that to be separately represented on chain outside the legal text itself, right? This sort of thing. So that by signing that transaction payload, you've entered into an arrangement where you that's legally binding to those contracts. Because that's happening with the same private key you can spend your money with, we can set it up such that you're not able to do that agreement signature unless you're also sending the money that you're supposed to send under that agreement at the exact same time, right? So in mergers and acquisitions, we used to have a phrase, there were two kinds of deals. There's a simultaneous sign close deal, and there's what's called a deferred closing deal, right? And this is atomic transactions in crypto are true simultaneous sign close. You do the transaction at the same time you sign it. Furthermore, even if you're doing a deferred closing deal, with our technology, we can trust minimize the conditions as much as possible. So you would first sign, and for example, that may escrow the money in a smart contract, and it's going to sit there until either some predefined oracle tells it that some condition has been satisfied, or if the time runs out, what we used to call in deal making the drop dead date, right, with the condition, if the conditions aren't satisfied yet, the deal is off, that money gets trustlessly released back, right? So, it's putting all these things together, using my deal lawyer knowledge, and my tech knowledge to, just really kind of elevate the level of corporate finance automation, right?
This is all really clicking for me. I mean, I've probably done about 30, 35 angel deals, but the things that you just mentioned, like, come up so often in my head too. And like, I'm not really crossing my T's and dotting my I's perfectly all the time. Like, hey, I want to make sure they've signed the document that I've signed before I send the money, like little things like that. But to have the ability to like sign and send funds and have that, like you said, atomically in one transaction with your custodial wallet is obviously way better form factor. The other things that my mind's kind of been running as you've been talking, and there was this team, I think they might have been called Venture Club, don't quote me, but they were trying to do tokenizing safes and having the ability to it was kind of like funding a project fully on chain. And they wanted to have like venture funds be fully on chain as well, and then have the ability to trade safes. Like, you could actually go into the private market and buy private equity safes from crypto startups via this platform. Like that's something that I also feel is like possible if you have all the tools to be fully on chain from the outset. But something else I want to get to, the more crazy stuff, is I've seen all this Claudebot, Moltbook, agentic stuff popping up everywhere. It's impossible to avoid it now. And, who knows when they take us over. They might take this feed over any second. But this idea of like this fully on-chain cybercorp combined with this agentic world, I just feel like where this is going is we're going to have agents be able to spin up their own companies. Is that a crazy idea?
Yes. That's part of, if you look at the tokenization article we released a couple weeks ago explaining our protocol, we have some design principles in bullet points at the top. And one of the top design principles is basically that it should be like agent compatible, right? And I think this is hugely important, and it's like one of the, it's informed the philosophy of why we've built things this way. We did do one experiment, because I think like one of the issues with these agents, it's already come up in some litigation where like a client went to a website, I forget the company, unfortunately, but it's a big public company. They did something with a chatbot on the website, and it was wrong information. Something got messed up, right? And they actually sued the company. They were seriously damaged by whatever happened with this chatbot. I can't remember the details. And one of the company's defenses that they tried to assert was, oh, well, this is an independent agent of us, and we're not liable for it. That argument was very quickly tossed out. But it does show that people are, the more autonomous these agents get, the number one, the more they have potential to do real harm in various ways. Number two, the less that any particular person is going to want to suffer the results, suffer the liability for that agent doing what it does, right? Because like, who do you even blame, right? I mean, is it the person who deployed the agent? Is it the developer who developed the smart contract framework that the agent uses? Is it both of them? Are they jointly, severally liable? There's like a million questions, similar to issues we've had with smart contracts, right? And so I think there will be a desire for ways to deal with this issue. One way you could deal with it is the government could pass a law that just literally says all these agents are persons, and like you're not allowed to create one unless you like give it a certain amount of capital that's like escrowed in a smart contract, and that like the government has a key for that it can use to like pay people who are injured by it or something. Then they would only have their own liability, right? Because they're persons, right? And there would be almost like an insurance scheme or something for them. But we already have something like this. I mean, we already have golems. We already have artificial persons. They're called corporations. Corporations are artificial persons. The reason why we made them artificial persons is because in our legal system, there always has to be a person who's liable for something. And so we decided to make we didn't want all the investors to be liable. So we decided to make a fake person, and that fake person can be liable. So we can do that. We did an experiment where we did that with an agent. We created a Delaware Public Benefit Corporation, which has certain special properties that make it useful for this. No, actually it was a non-stock. It was a non-stock corporation. Forgive me. But they're similar. And we put, I made an agent of myself. I gave that agent the key to a multi-sig, right? The only key to a multi-sig. And I cross-referenced that multi-sig in the non-stock corporation's bylaws and certificate of incorporation for decision-making of that entity. So what I would argue this does is like that entity, it's not a person, that agent is not a person, so it can't actually own anything under the law, but functionally speaking, it's as close as possible to owning that entity. And anything that agent does, I would argue, is a liability that should be attributed to that entity, right? And so I think this kind of on-chain entity stuff can, not only might these entities want to interface with the banking system and need a legal personhood for that purpose, but also for the liability reasons. I think this could be like a really big area that intersects with the stuff we've been doing.
We normally kick off the podcast with, asking builders, investors, any guest about, what is your background? What have you worked on? What drives you? I think today, like, we had to get right into this post from Vitalik, and again, I think it's helped us to get into deeper topics with you that I know you think a lot about related to Ethereum, building for this, cybernetic on-chain world, however you want to describe that. But I feel like it's more obvious today than ever because of AI agents, and it's more obvious because of just all the money that's gone into AI, that people are seeing what's possible now with AI, and they're believing in this like more digitally native future. You've always been ahead of the narrative there. So I actually want to like spend the last few minutes of the interview talking more about like what drives you. Like, I've always been fascinated by like what do you get up in the morning, and what makes you want to keep working on the things that you're working on here? Because you're
Right.
working on something that I would argue very few people are. Like, you've always been at this sort of bleeding frontier of Web3 tech.
Yeah, I mean, I think it's imagination, honestly. And in a certain sense, it's aesthetics, because like I grew up reading like all the cyberpunk novels, from William Gibson and stuff like that, and I was a very precocious reader. I was reading like Nietzsche when I was 12 years old, and reading a lot of sci-fi, and in particular the book Neuromancer by William Gibson with his cyberpunk, not cypherpunk, sort of vision of the future really captured my imagination. And, when I was younger, I was trying to become like a sci-fi novelist at one point, right? So like I capitulated, I went into big law, it's just like, oh, I need to make money, like this novelist thing is not working out. I went into big law, and like for a time, I truly became like an American Psycho type of like normie, you know what I mean? Just like fully in the corporate world. I mean, I was, at one time I was probably honestly one of the like star up and coming corporate law talents in the United States, I would say. But I started watching the show Mr. Robot, and I started learning about crypto and some things. And this old kind of self came out of like, wait a second. It was almost like a midlife crisis before my midlife of like, man, what am I doing, man? Like, what am I even living for? I'm doing these same agreements over and over again. There's zero innovation. They deal with jerks all day. You know what I mean? And so, I decided, I want to try to be future oriented and to try to always think about, like make the future happen, change the image of lawyers. I thought to myself, like, what would a lawyer look like, like in the Neuromancer universe, right? There'd probably be some kind of like samurai with a lightsaber who's like also a hacker or something like that, So this type of vision, just the excitement around the future, and try to make the world a better place in the process. Get rid of the things I don't like the spending a month on and like $50,000 on a deal that like has been done hundreds of times before and should be able to do 5 minutes in 5 minutes. I just find it very motivating and like has interesting intellectual puzzles and so on. Yeah.
I don't know how early you got into Ethereum. I thought you've been around since the pre-sale, but I got into the space in 2017, and I also was watching Mr. Robot.
Nice.
I never thought of Mr. Robot as driving me into crypto, but I was amused by the fact that they were referencing crypto, and it was becoming a more mainstream topic.
They nailed it, though, because there's that conversation between the CEO of eCorp and the Fed chairman where he says, hey, I need to have eCoin. I need to have eCoin, and you need to give us eCoin because otherwise China with Bitcoin is going to get too much power over the world's financial system. And I'll give you a backdoor into eCoin if you don't try to stop it, right? And I feel like with custodial stablecoins and everything that's happening with the Genius Act, I mean, a lot of this is arguably kind of coming true. So it's a prescient show, yeah.
Gabriel, so what does the, I guess, next 12-month roadmap look like for MetaLeX, and maybe what parts of the roadmap are you most excited about?
Yeah, so we have, we've put in place all the core elements of what we wanted to build, right? We have a tokenization protocol. We have a set of deal technologies that can, trustlessly do things with those securities tokens, and we have ways of representing entities on chain, right? So all these core elements are there. So one of the really big things that I hope to accomplish this year is to have some sort of liquidity product, because right now the tokens, and there are regulatory reasons for this, the tokens are transfer restricted. They're illiquid. That's all under the control of each founder of each company, of course. But what I'd like to be able to do is develop a set of solutions where I can go to founders who have used MetaLeX to fundraise and say, hey, you've had investors, that have been sitting on your cap table for a year or more with these tokenized securities. Well, do you know what Rule 144 is? Do you know those investors could actually trade those securities without you having to go public? And here's my idea for how that could be pretty beneficial to you, right? And so I would like to now have those securities tokens trade on like an AMM, that we design and things like that. So that's one really big goal. We also are working with a lot of other platforms to try to get our technology adopted by them and sort of become, I don't want to say a single unifying standard, but a standard used by multiple projects, right? And so, our collaboration with MetaDAO, which ironically is a Solana project, but that's been great. They use BORGs as the, basically they say you can't do a launch on our MetaDAO launchpad unless you have set up a MetaLeX BORG that has rules around using the decision market in MetaDAO as its governance mechanism, right? And we're working on a lot more partnerships like that. So I think all of this is about doing our own experiments, feeding into other marketplaces, and trying to have a true Ethereum native corporate finance layer where you can look at your wallet, you own those tokens. There's no intermediate. The only trust relationship in that, of course, there's securities, so there's centralization, but we've whittled it down to the point where that trust is just between you and the issuer, right? That's the unavoidable layer of trust. There's no broker dealers, there's no brokerage, there's no DTCC, there's no tech vendors, there's no SaaS sales guys, none of that, right? And to have this kind of be the entity and corporate finance layer of Ethereum. And I think we can make a huge amount of progress on that this year.
Before we let you go, have you spent much time on how Robinhood is tokenizing stocks? I'm just curious, like, are they doing a good job?
I mean, not much time, but I roughly know what they're doing.
Does their view of how to tokenize stocks, does it mesh with any of your views?
I think what they're going to do, and I think we'll see a lot of this because it's very attractive from a commercial point of view, because you can get high quality assets fast. And this is probably the only way to get them fast is, of course, there are shares of SpaceX trading around on the secondary market. There are shares of OpenAI trading on the secondary market. Even though they're not public companies yet, there are early investors in those projects who had an opportunity to sell, and they've been selling. And so that broker that you mentioned earlier, they've accumulated a lot of these shares, right? And so, but other people also have them. So what you can do is you can have an SPV, which is essentially like a limited liability company devoted to a very narrow purpose, own those securities, right? And then you can have that entity issue tokens of some sort. What sort will it be? Well, it could be a range. Some that you see are just kind of like basically style like stable coins, where it's like, they're out, like we're going to say these are backed one-to-one by securities that we own, but we're not going to tell you they give you any rights. But they are backed though. So you could probably trade them as if they are the securities. But just know that you have no rights against us, right? A different way to go is to actually tokenize the LLC membership interest or the limited partnership interest in that SPV, right? And since that SPV only holds one kind of asset, which is these other shares of SpaceX or whatever, well, basically trading those tokenized membership interests in that SPV is just arguably just as good as trading the securities themselves, and they should be priced as a function of one another, right? So that is what, that is sort of a more robust way of doing this without involving the issuer's consent and participation, and it can get you very high quality assets. So I believe that's going to be what Robinhood is doing. It's also what something called X stocks that Kraken recently acquired a company that does that. That's sort of their model as well. And for people who just want exposure, economic exposure to that security, it could be a pretty good option. Obviously, there are trade-offs, of course, because number one, your claims are more attenuated. Number two, you don't have you're not going to be able to vote your shares in on like SpaceX proposals, right? Like you don't have any direct rights. And you're going to be an equity holder in a partnership, which means that like you're going to get tax forms every year and stuff like that, right? Arguably. So there's some trade-offs there, but since SpaceX is not going to want to tokenize their stock today, and other really blue chips that haven't gone public yet aren't going to want to do that, that's the best way to get sexy assets to trade today. So people are going to be doing a lot of that.
Yeah, we're hoping that they allow for trading pre-IPO companies. That was a big part of that announcement. But just to be able to trade stocks on chain would be pretty insane. Mainly because I would like to be able to access all of our favorite DeFi primitives. Just being able to borrow on something like Aave would be fantastic. Versus I feel like the tools that most inherit are next to nothing. And then if you've got enough money, then you've got access to certain tools there, but there's always a middleman there.
But there's very interesting questions with that, right? Like, how does SpaceX feel about this? Do they want this or do they not want this? There was recently a lawsuit by what's the weapons, the hot weapons startup, Anduril. Anduril sued one of these guys, but he was doing it completely fraudulently, right? But it loses some control for the company and its founder to be able to control their magic moment of going public, right? And so there may be it'll be interesting to see how all that plays out. Will they say, oh, I can't stop this, so now I want to directly tokenize? Or will they try to stop it, or what will they do? I don't know. But it's going to be, the tokenized securities are going to be just as interesting in the next 2 years as I think DeFi was in 2020, 2021.
Gabriel, we would love to have you back in the future. I wasn't sure of the many different directions we could go here today, which one we would take, but I appreciate you just navigating all these topics with us. And of course, MetaLeX, we're super excited to be able to learn more about as well.
My pleasure, sir.
First, though, I want to remind our listeners they should learn more about MetaLeX by going to metalex.tech. They should follow MetaLex_labs on Twitter. Follow Lex_node on Twitter. We'll put all that into the show notes so you can easily find that. And then, Gabriel, any final word for us? Just thank you so much for your time.
Say, man, keep building cool stuff on Ethereum.
Thanks everyone for tuning in. To stay up to date with future episodes, plus get expert tips, strategies, and exclusive content, subscribe to our free newsletter at the-edge.xyz.